Hey everyone, let's jump right into this explainer. We're looking at a pretty radical shift today in how people are generating passive income. Now, for generations, the absolute holy grail of preserving wealth has been physical property, right? But today, we're exploring a huge transition out of the physical realm. We're going to pit the traditional real estate headache against the harmony of a brand new digital asset class.
So let's start with the core problem we all face. It all boils down to this. Money really just has one job. It's supposed to store the value of your hard work until you actually need it. But as the source material points out, inflation acts as this slow confiscation of your time. When fiat currency gets debased, it's constantly skimming right off the top of your stored labor. It traps everyday people on a financial hamster wheel, Just saving your paycheck literally means you're actively losing ground.
And the crucial number you really need to remember here is 7%. Historically, if we look back over the last 100 years or so, the US dollar has lost its purchasing power at an average rate of around 7% every single year. Because of that insane drag, you're essentially forced to take on a second job as an investor just to stand still. Think about it. If your investments aren't paying you more than 7%, you are literally getting poorer. And to beat that hurdle, well, historically, people have turned in droves to physical assets, specifically land and real estate.
Which brings us to Section 1, the real estate headache, escaping inflation through physical effort.
So that traditional escape route has almost always been buying physical real estate to protect your wealth. Investors go into it expecting this smooth, totally passive return. But the reality? Oh man, it is anything but passive. Physical assets rust. They decay. The source material makes a great point here. When you buy property, you aren't just buying an asset. You are buying a second job in property maintenance. You're taking on the liability of bad weather and a massive drag on your mental headspace. You're buying a highly tangible burden. To put this into perspective, the sources highlight a story about a family in suburban Wisconsin. They bought rental properties to finally escape that hamster wheel, right? Only to get absolutely hammered by a hailstorm that ruined the roof. And because of that, their insurance jumped 100%. Then the tenants moved out. Ultimately, these landlords were literally forced to drive over and mow the lawns themselves. After all that intense physical labor and stress, their cash-on-cash return was just 6%. I mean, that is the ultimate real estate headache.
All right, let's move on to Section 2. Enter digital capital, property in cyberspace.
So what if you could step off that physical wheel entirely? Unlike physical land, even prime real estate like Miami Beach or Boston, where developers can literally just reclaim swamps to build more land, digital capital, specifically Bitcoin, is absolutely scarce. The sources actually compare it to Cyber Manhattan. It is hard-capped at 21 million. It doesn't rust, and a hailstorm certainly can't ruin its roof. It functions as pristine property that requires zero physical upkeep.
Now for Section 3, digital credit, the harmony of frictionless yield.
But here's the thing. Storing value is really only half the equation, right? Investors also want cash flow. Enter digital credit. Companies are now issuing digital credit against their digital capital reserves. You can kind of think of this as a digital money market. By using a highly appreciating asset as the underlying collateral, these instruments are designed to pay out passive dividends, often in the double digits actually, while stripping away the extreme volatility you usually see in the crypto market. It's essentially the harmony of yield without the headache.
When advocates compare the metrics side by side, a total paradigm shift emerges. The argument here is that you can effectively double your yield, jumping from that 6% real estate return to an 11% or even 13% dividend. And the physical effort? It drops from fixing roofs and dealing with tenants down to absolute zero. It just sits right there in your brokerage account. Plus, instead of an illiquid asset that takes months and months to sell, you have daily liquidity traded on public markets. It's pretty wild.
Man, it's not just retail investors paying attention to this. Institutional players are flocking to digital credit because it solves some really major problems in traditional finance too. Usually, to get these types of double-digit yields, institutions have to subject themselves to like 90-day lockups in hedge funds or grueling 7 to 10-year lockups in private equity. And worse, they get hit with massive management fees, like that classic 2% fee and 20% carry. Digital credit just eliminates those fees, completely removes the multi-year lockups, and provides entirely transparent collateral.
The sources actually refer to digital credit as the kerosene of finance. And looking at the raw numbers, you can absolutely see why. A standard bank account or money market might net you, 3.5% after taxes? Which, remember, doesn't even beat that 7% fiat debasement rate we talked about earlier. Physical real estate might net you 6% after all your expenses and your physical labor, but digital credit is currently yielding between 11.5% and 13%. that drastically outpaces both traditional banking and physical property options.
Which brings us to Section 4, Demonetizing Land, the Paradigm Shift.
This leads us to a massive, really systemic question about the whole future of physical property as a store of value. Think about it. If you can secure double-digit yields with zero physical overhead, zero tenant issues, and zero insurance hikes, why on earth would you buy a second, third, or fourth house just to protect your wealth? Currently, physical real estate holds this massive monetary premium precisely because people are forced to use it like a savings account. Advocates believe that as digital credit becomes mainstream, physical real estate could actually become demonetized, losing that inflated premium as investors just migrate over toward digital harmony. Ultimately, experts view digital credit not just as a stock ticker or some simple yield play, but as the ultimate transition asset. We are living right between a fiat reality of constant debasement and a future digital economy. Digital credit acts as a bridge. It allows people to comfortably compound their wealth and generate passive income, all without having to perfectly time market cycles or suffer the pure volatility of raw digital capital.
As we witness this potential evolution from physical burdens to digital harmony, it really forces a deeply personal question about your own wealth. How much physical friction are you willing to endure for a fraction of the yield? Are you going to keep battling hailstorms and mowing lawns just to outpace inflation, or is it time to explore the frictionless harmony of digital credit? Thanks for joining me on this explainer. I really hope this sparks some serious curiosity about the future of your assets.